If you're earning between $750,000 and $1.2 million annually, 22% of employer plans offer a strategy that could put nearly $4 million into tax-free growth. Most high earners never check if their plan qualifies. The numbers in this video come from IRS contribution limit guidelines, Vanguard's analysis of 1,500 employer plans, and the Congressional Budget Office. The mega backdoor Roth mechanics are from IRS Notice 201454. The qualified business income rules come from the tax code itself. Strategy 1. Mega Backdoor Roth. Your 2025 401k limit is $70,000 total. Most people contribute $23,500 in employee deferrals and stop. But if your employer plan allows after-tax contributions, you can add another $46,500 and immediately convert it to Roth. That's $93,000 annually for a couple converting to tax-free Roth. 20 years at 7%. $3.8 million that will never be taxed on gains or withdrawals. Here's the catch. Only 22% of plans offer this. Call your benefits administrator today. Ask 2 questions. Does our plan allow after-tax contributions? Does it permit in-service Roth conversions or immediate rollovers? Both must be yes. If your plan doesn't allow it, this strategy isn't available to you. This works for anyone with W-2 income and plan access. No business ownership required, no complex entities, but you must verify your specific plan allows it. Most don't. Strategy 2. QBI Deduction. The Qualified Business Income Deduction was made permanent in July 2025. It's no longer expiring. 20% deduction on qualified business income. Phases out starting at $394,600 for married couples. Executive earning $800,000 from W-2, 0 QBI deduction. Same executive adds S-Corp consulting income of $200,000, now qualifies for a deduction. But here's what matters. Above the threshold, you need W-2 wages or qualified property to claim the full deduction. $70,000 in S-Corp wages gets you $35,000 in deductions, $12,950 in tax savings. To claim $40,000 in deductions, you'd need $900,000 in qualified depreciable property. Most consulting S-Corps don't have that. The wage-only calculation is more realistic for service businesses. This isn't about gaming the system. It's tax architecture, separating business activities into appropriate structures before you earn the income. Meet with a tax strategist before November if you have any pass-through income. Structure matters, and it needs to happen before year-end. Strategy 3. AMT timing. Alternative minimum tax still catches high earners through poor timing. Regular tax allows state and local deductions up to $10,000. AMT disallows them completely. Model your return for both systems. Then time your deductions based on which you'll face. If you're in AMT this year, accelerate charitable contributions because they work under both systems. Defer state tax payments until next year when you'll be under regular tax. Don't exercise incentive stock options because the spread becomes immediately taxable under AMT. Strategic timing of deductions between AMT and non-AMT years can produce meaningful tax savings for affected taxpayers. Most tax software doesn't automatically show AMT. Force the calculation. Model both scenarios. Adjust timing of controllable expenses. State tax adds another layer. California, New York, New Jersey. They don't follow federal rules exactly. The SALT cap hits these states hardest. A strategy that saves $15,000 federally might save $3,000 more in a no-income tax state like Florida or Texas, or cost you differently in California. Always run state projections before implementing federal strategies. If this is the first time you're hearing these specific numbers, subscribe to Smart Modern Wealth. We show you what works at your income level, not theory, but executed strategies with real math. If your employer offers a 401k, call benefits this week. Ask about after-tax contributions and in-service conversions. This is time-sensitive. Every month of delay costs compounding. If you own a business or do consulting, meet with a tax strategist by November. Entity structure needs to be in place before you earn next year's income. If you're earning over $394,000, model regular tax and AMT within 30 days. This determines every deduction timing decision for year-end. After-tax 401k contributions cost nothing additional if your plan allows them. Entity restructuring for QBI typically runs $5,000 to $15,000 in legal and accounting setup. AMT modeling costs $2,000 to $5,000 if your CPA isn't already doing it. These aren't aggressive strategies. Mega Backdoor Roth follows IRS Notice 201454. QBI follows the tax code as written. AMT timing is fundamental planning. The families paying lower effective rates aren't cheating. They verified their plan qualifications, structured entities correctly, and timed deductions strategically. Smart modern wealth doesn't leave $4 million in tax-free growth on the table. They call benefits. They structure entities. They model both tax systems. You just learned 3 strategies with implementation steps and real 2025 numbers. But here's what else these families do. They skip strategies that don't apply to them and double down on what does. 78% of plans don't offer the Mega Backdoor Roth. If yours doesn't, there's a different move that works even better for your situation. We'll show you the decision tree, how to know which strategies actually apply to you and which ones waste your time. Watch now.